All right, welcome to our final session of the day. We are going to be talking about what no one tells you about selling your company for hundreds of millions or more with Woodside Cap. I am delighted to welcome Mark Bagley and Tricia Salinero from Woodside Cap. Both of you, thank you so much for joining us. I'm going to pass it over to you to take it away.
Thank you very much. Welcome, everyone, and well done for getting through the last 2 days. This is the last session, I believe, so we've saved the best to last, hopefully. Like you just heard, we are going to talk about, we're essentially going to give away the secrets of how to get a good valuation for your company. Now, I'm a bit nervous about this, Tricia, because I feel like the magician about to give away our secrets, and I imagine there's going to be an angry horde of virtual bankers chasing after us virtually after this, if we're not careful.
Yes, indeed.
So Tricia, why don't you tell us a little bit about your background and why you should be good at talking about this topic?
Sure. Thanks, Mark. So I've been working in mergers and acquisitions for 20 plus years, done nearly 100 transactions, and mostly represented sellers. And so, during the presentation today, I will be giving some of the seller tips, some of the things that you might be interested in implementing ahead of time in terms of pre-acquisition positioning, but generally talking from the seller angle. And Mark, maybe you can give a little of your background and talk about your focus.
Yes, I'm more recently into banking, but before that I was on the buyer side. I was on the corporate side, so I saw a lot of these conversations from the other side are being pitched to. And so I will bring that perspective to the learnings here and how best you can pitch to a buyer and have a successful engagement. So why don't we get straight into it? Like we said, we're talking about selling your company. So Tricia, tell us how it all gets started.
Sure. Happy to sort of share where this often comes, in terms of the beginnings of getting to know a buyer. So sometimes you'll get a corporate development inquiry. You'll get someone from corporate development, large public company, small public company, someone from a private equity backed company that will come and say, hey, this is an area of interest. We'd like to get to know you better. Sometimes you'll get an email, cold email from a private equity firm. It might be more likely from someone who's junior. Someone who's been straight out of college, spends 2 years sending thousands of emails to companies. And, that's a typical approach that private equity will employ to get that first conversation going. And sometimes it will be a partner. And so a partner might say, let's explore, having a stronger relationship. Let's explore, deepening our relationship. That's all code for, hey, I think I might be interested in buying you. And what the ultimate secret here is that selling your company is an enterprise sales job. So in the same way that you're doing B2B SaaS sales, large enterprises, that's how you have to think about selling your company. You're creating awareness through, public and conversations and things like that on your website. Maybe you're telling stories about usage of your product, but creating that awareness through PR is very important. Second, you're really trying to understand, what does that pipeline look like? How do you take the large number of companies that might be interested and whittle it down through gauging their interest through this process, and then getting to the right decision makers. So, we all know when you're selling a product that you need to understand who are your buying influences. Who are the decision makers? Who's going to write the check? It's the same in mergers and acquisitions. If you're selling your company, you're selling yourself as a product. You're selling the company as a product, and finding out who those decision makers is a big deal and a big part of that process. And then again, it's a sales funnel. So how do you take action on that as well? And, we're happy to go through some of those, action points along the way.
That's right.
And then in terms of building that funnel, building that sales funnel for your company, what we found is that there is a long tail of acquirers. So you may actually think that there is, the top 3, 4, 5 companies. And so I want to talk about, what does that really look like? When we look at the number of acquisitions of VC-backed startups, about 7,000 of them over the last 5 years, but they were made by a number of companies. So, Mark and I tallied that the top 20 acquirers, about 6% of that total number of companies. So while Google and Facebook and Salesforce might all be on your list in terms of the perfect acquirer, more likely it's going to be a company that is in that long tail, a company that's going to do maybe one deal over that 5 years. And so it's very important to extend that network and understand who are those companies, in the long tail. And that can, send a larger message about your company. It can also increase your odds, quite frankly, on getting something done.
That's right. So we talked about this inbound from a buyer, and I wanted to talk to the signs that you can get that a buyer is serious. Well, we already said this is an enterprise sales process, so it won't come as a surprise for us to tell you that you don't really know a buyer is serious until they get to that very end, when you get the offer, when you get the deal. So, but there is a continuum of things that you can look for, and I'm gesturing here. So one hand, I hope you can see my hands, but there's a whole continuum that you can look for. On the one hand, you start off with no interest, and the other end is the offer. But in between, there's behaviors you can look for, and those behaviors are generally around a buyer increasing the amount of people that are involved in the deal. So now you've got to be a bit careful, of course, because we all know corporates, they have a core discipline, a core skill of theirs is that they have no shortage of people to have meetings. So you do need to look for people being involved that are not sideways moves, but are upward moves. So let's go through a few of those. So the NDA, of course, the NDA is a signal to say, I want more than public information. So, give me the inside details. But also what's not known is that it's a non-trivial thing actually to get an NDA signed inside a corporate. It has to go to another department. They'll red line the documents and send it back. And anyway, it's an aggravation to some extent. So that actually is a small signal that you're on this continuum of now the corporate is saying, well, I like this enough that I want to go through the hassle of doing that. So that you've started on the process. A more interesting development is when you get to the business lead. Maybe that's head of product, it's head of engineering, head of strategy, someone like that, and then you get to present in front of them. That's clearly, you're on your way. Then that's a decent presentation to have. It's a good threshold to put on and you use these thresholds basically to say, should I allocate resources? How much of my time should I allocate to? So you want to get further down. So that's definitely a stage where you want to get involved, and then further on, closer to the area where you're going to get an offer, this is where you're talking to the person that owns the budget, whether it be the partner, the senior person in the private equity, P&L responsibility in a corporate. And so now you're getting to a very serious situation, and you're on that serious continuum of getting quite close to the deal. So let's talk a little bit more about acquirers and what they would like. How you can more easily get on that continuum. So what's the process moving on that continuum a lot quicker? So a corporate acquirer is really looking for a surprisingly narrow set of things. And these things, generally speaking, there's usually a few secret things, but I don't know, 80, 90% of the things you can find out by looking publicly. And obviously with a public company, there are public filings as well. So you can actually look in the public filings, but they're also going to present at conferences. It'll actually be written in blogs about where they're going with the product, what they want to do with it. So there's no real surprise of where they are in the market. And even if you don't manage to glean any of that from the very private company, they don't publish anything, maybe like an Apple, you can also glean where they're going to go by what their competitors have done, right? Because they're generally speaking, if a competitor is launched in the space, there's a good chance they're going to do that as well. So you can get this information. So when you go to a corporate acquirer and you say, would you like X? You have to know that's a rhetorical question. You have to know the answer is yes, and that's what you're expecting, right? So, so it's very important that you are familiar with the corporate and their products and where they're going. But it's also even better on that continuum is that the corporate is familiar with you And it's kind of the pinnacle of that is that you're already a partner. Again, there's stages before that, but being a partner is going to get you way along that continuum. So this is where you say, well, this is worth me putting some effort into it. So now, when you present to a corporate, please don't present in the same way you present to an investor or for a sales pitch to get some deals. You want to be presenting a very clear view of the value proposition of your asset, your company, to that acquirer. So you need to put it in the context of where it would fit in their company and where the value comes. So if you buy my company, this will enable you to do X, move into market Y, gives you a stepping stone to Z, or helps you compete with a competitor A. So you need to put it in that context, right? And the same for the financials. Yes, they're interested in the raw financials, but they're actually interested in the subset of the financials that say, here's what my company would look like as a business unit inside of your organization. Now, on the financial acquirer side of things, it's a little bit, it's a lot the same, but a little bit different. And Tricia's going to talk to that.
Sure. So financial acquirers, and typically they're private equity firms, they might be a family office. Those acquirers who are trying to do either an add-on to their existing portfolio company, or they're trying to find a platform company that they can then, add on additional acquisitions over time, grow it, refine it, and then sell again. So when they look at that, they're looking at what's a critical mass for them to start as a platform company. And typically that critical mass is really around kind of the $10 million, 10 million ARR revenue point. And so that's sort of the first metric. The second metric is if you're profitable, that's even better. You're opening up really the realm of companies that can be interested in you. So there are a smaller set of groups that will be interested in acquiring companies that are still growing very fast but losing money. There's a larger set where once you have $1 million worth of EBITDA, that will be interested because of that metric. And then above sort of $3 million in EBITDA, there's a much, much broader option in terms of the number of private equity firms that you can go to. Oftentimes it's good to go and look at their portfolio companies. You'll get inbound calls from these private equity firms, but they might not always be the best fit because they don't have enough on the portfolio company side to be truly interesting. And so really go look for that synergy, just in the same way that you treat them like a buyer, like Mark had been talking about. They're looking for motivated management teams. Are you going to stay? Or if you are looking at, what are succession opportunities? Maybe I've been running my business. I'm not, as enthusiastic about it anymore. I'm trying to take some chips off the table. If it's a succession opportunity, really be upfront about that, because they often have managers that can come in and run the business after you're gone or after some sort of transition period. The magic words here, honestly, a rule of 40. So the rule of 40 is taking your growth rate percentage plus your EBITDA margin. And if that is 40% plus, 40 plus, that is, magic words to private equity. They're really looking for, how do we accelerate growth? How do we put efficiency in the back office? How do we merge this with other portfolio companies if that's part of their strategy? And how do we drive good margin? Because they will be measured on that in a subsequent acquisition. And so they're really looking for that efficiency monitor. And I think, there are a number of private equity firms out there, and it's often good to put, a large number on the list and get them information, because that list will whittle itself down through this process. Companies, private equity firms will come back and say, this isn't a great fit because it doesn't meet our metrics. This isn't a great fit because we don't have a portfolio company in the space. We don't have a manager if you want this to be a succession opportunity. And so again, it's about finding the right blend of those, ideas to get to the right person. And again, when we talk to you about who does the approaching, it's typically a junior person. It's an analyst, it's an associate. So make sure that as you're getting through this chain of conversations, that you get to a partner, someone who has a decision making at the private equity firm and can move forward, under their own power. They're essentially taking P&L responsibility for the opportunity.
All right, let's see. We know these folks, everyone wants an easy life, right? So how do we make it easier what can we do as a seller to make things easier? And let's talk about that a little bit.
Absolutely. So there are a number of things that you can do 6, 12, 18 months in advance, but things that make you easier to review, assess, and ultimately digest, if you will, are clean financials. Make sure that you have them professionally reviewed. Auditing is not necessary, but have someone take a look at them to make sure that they're sort of consistent with GAAP. And so generally acceptable accounting principles, really that is the measure by which financial buyers and strategic buyers will make their assessment. And oftentimes there are companies who may not have institutional capital, have been growing their SaaS business, but have really been thinking about it on a cash accounting basis. That is great for managing your business. It is a little bit more difficult to assess when you are, a buyer in the world. So please, work on your financials first. Make sure that your employees have signed invention and assignment agreements. I can't tell you the number of times that a company will, look at the records and they're not finding that everyone has, given over their intellectual property. Somebody mentioned at one point, what is EBITDA? It's earnings before tax and depreciation. It's really a good proxy for it is your operating income. So what is your operating income? And that's a number that you might be able to add back to because you're running certain things through the business that are, either more personal, like a company car, or you're running things for tax reasons that might be, more beneficial to you on a standalone basis. But looking at that operating income and making sure it's sort of a clean reflection of what the business can do is important.
It's also a pure number, right, Tricia? It's a good number to compare between companies. So if you're going to use a number, EBITDA is a good one to go with. It has some ups and downs, but a good one generally.
Yes, absolutely. And that'll give you, I think a general rule for, where your business can contribute margin to the acquirer. So there was another question about, why it's hard to assess on a cash basis and GAAP accounting. So cash basis numbers typically are much more focused on, sort of what is the monthly, intake, outtake, right? As a buyer, though, since they have to report under GAAP in all cases, they need to be able to do an apples to apples comparison. And so they need to understand, look, did you take all that cash up front for an annual contract? Well, that's meaningful to them on a balance sheet basis, because they may not be able to recognize some of that revenue on a go-forward basis. And so really, if your accountant can help you at least take a look at GAAP accounting and accrual accounting, that will help, make this conversation a lot easier. Mark, what about some of the buyers' things that make it easier?
Yeah, so on my side, when I got presentations, here's what I wanted. I wanted 4 slides at the most. I wanted a 4-slide exec presentation. So, and here's what's in those slides. So I certainly wanted to know the problem that you were solving, and of course, it's kind of awkward if that problem is not something that the buyer's got a problem in. So it definitely needs to be a problem that the buyer has as well. And the second one, no surprise to hear, the second one is about the solution. So I want to know the solution. What have you found that can solve that problem? And again, it has to be something that the buyer that I did not already have. So you need to do your homework. The third one is the most important side, and this is where a whole lot of discussions kick off, and hence why you only need 4 slides. But the third slide is about the success metrics. Give me some idea of the success you've had in selling that solution into that problem. Is it something people want to pay for? Because that's ultimately what a business is about, right? And so give me any kind of metric. It doesn't have to be like I've made 100 million in that. It needs to be more around the growth. Here's what I've done. Here's what I learned. Here's where we got good traction in the market. It sells best into SMB, not into large enterprise. Enterprise costs too much, takes too long. You know, whatever it might be, give us a story about that. I want to know the success. And of course, as a buyer, I won't know anything about this product. So it's not like I've got loads of people sitting around that will have inherent knowledge of this product and be able to sell it. So tell me how you sell it. I want to know that learning. I want to know what mistakes you've made, what I should not do in terms of selling. And then the fourth slide is kind of about the longevity of the assets I'm buying. So I want to know things around platform. Is it a platform? So are there other players you've got on the same platform? Is it easy to take it into a different vertical? If you're in one vertical, can I go to another vertical very easily? Not much cost. It's the same product wrapped differently. So things like that. And do put the whole thing, we talked about this, touched on this earlier on, but put the whole thing in the context of an asset that I'm going to use to further my company in the market. So with your company, I can then go into market A. That means I, talk about the competitors as well. So I can then compete with such a competitor because they've already in the market. And so do give that dynamic about where it fits, because you want to come along with a presentation that says, well, don't leave it to the corporate to have to put 2 and 2 together and make 5. You want to come with 6, right? You want to come with, here is the answer to what you're about to ask me about where this fits. So do that. Now, fourth one, a little bit two-sided, this one. Yes, you do need to have some knowledge of the buyer's organization. I think that's just polite, right? To have some knowledge of the organization that you're about to go into. And so that helps with kind of suggesting next steps, where should you go next? Because you'll have as much idea about that as the buyer will. Not that the buyer, doesn't know what to do, but, can I suggest it's best suited into the SMB space? This is why, etc. So that'll be part of your pitch. And then, of course, it's quite handy if you know the organization to know where when we talked about sideways versus upward move. So we're looking for that upward, move up in the hierarchy. So if the next step is suggested is a sideways move, you need to be making noises about that not being the best, and subtly trying to get a slight raise up in the hierarchy. All right, enough about that. So we're going to get to the topic that I'm sure everyone's been dying to get to, and this is what we teased at the start. So Tricia, we're going to talk about valuation. Now, there's a terminology that goes around that, there's a valuation and then there's an enhanced valuation. So how do we get to that enhanced valuation?
Sure. So we can tell you a little bit about how advisors, how buyers, how financial investors look at valuation. And I'll tell you just right up front, it's a little bit of an art, not a science. The science piece of it is, they'll often look at public company comparables. If you haven't gone to the Bessemer Cloud Index, we put a link there. Type in Bessemer Cloud Index. That will give you a bunch of public companies in the SaaS space and what they're trading at. You can sort by multiples. You can sort by growth rate. You can sort by all sorts of things. And I think that'll help give you an index for the types of companies that you might be compared to. And it's fairly sector specific. So companies, in slower growth areas are trading, it's, less than companies that are, trading or growing very quickly year over year. So we sort of take public company comparables first, and we put a little bit of a discount on them because, public companies are bigger than you are. They have more market press releases and things like that. But at the same time, there's some liquidity. So, theoretically, they're trading at what the value is that the market will afford. And then you get a couple bumps. You get bumps for growing faster. You get bumps for, better than 100% retention. So kind of a net retention number that is, growth in your existing customer base. and essentially a lack of churn in your customers. You'll get growth, bumps for gross margin. You'll get bumps for whether or not, the company that's acquiring you can expect some payback within a relatively short period of time. So those are all financial metrics, and you can marry those public company comparables with private company comparables. So to the extent that there've been transactions in your sector, you can look to those to the extent that you can get available information on how big they were or how much revenue they had before they were acquired, and get a sense of kind of what the multiples are. What I'll tell you though is that everyone will put forth the multiples that support their thesis, right? So they'll say, we want to value you on the low end, we're going to give you low multiples. If you think you ought to be valued on the high end, you're going to go look at the higher multiples, right? And then again, that's all on the financial side. What really though drives high value exits and high value investments is the strategic valuation. So why does it have to be now? Have there been 1, 2, 3 deals in the space? Have there been is the buyer afraid of losing out, right? And how many of those potential buyers can you get to the table? And so all of those things, I think, are really elevate that opportunity to grow the multiple, to get a higher price, to create that sort of competitive environment.
Yeah, and on the buyer side, you won't be surprised to hear, or maybe you are, but it's exactly the same process in reserve. They're trying to do the calculation on the left, more from the point of view of getting the price down, but they also have a figure in mind of what it's worth to them, and that's on the previous slide we were talking about the presentation, painting that nice picture as well, so about where the worth is. So let's delve down a bit more deeper in that. We've got another slide on that. So for the strategic buyer, let's look at the valuation and the elements that add value and decrease value, reduce value. So like corporate, here's another surprising thing. Corporates are humans. And so humans, like, as we know, motivated by a lot of things, but greed and fear are up there top of the list, right? So certainly a corporate as an entity, but also the individuals are certainly motivated by finding another product, going into a new market, getting some more revenues, getting a bonus from that. Sure, that's a big motivation, but maybe 2x to 5x a more potent emotion is fear, and particularly fear of missing out. So this is going to be where you need to play on. So and to the extent that the fear is so much of a motivator, I think that if you're second to sell into a market, one of your competitors already sold to a large company and got a good outcome, it's much easier the second person. Obviously, a lot of marketing and press has been done beforehand, so that kind of the new market's been understood. But there's also motivation there about the almost desperation that you need to get something in market, and so that will raise valuations for sure. And then another fear factor that puts fear into the hearts of a corporate is when you come arm to arm with an M&A advisor, a banker, because that signals a couple of things. It signals that it's going to be a competitive process, right? They're not just going to be able to come in and give you an offer and you don't realize that whether that's a good offer or not. It's the banks obviously have done this a number of times. This is normal for them. So they know they're going to get a competitive process. They know they're going to get a stringent process where there's a lot of diligence around the valuation that's offered. And they know, I mean, this is a perception thing, but the perception is that because the bank's involved, you've got a number of people involved already at the table. So there's already people sniffing around. And so you act, and it kind of act to speed up the process as well. Now, on the risk side, what can be detrimental? Well, there's kind of hygiene aspects to your company that I'm sure you've had, and they're not negative, but they're only negative if you don't have a good narrative, a good story around them. So do be ready with a good story, and don't be shy in giving out that story if it comes up. Do not leave it towards the end of the process, because that is very detrimental to evaluation. early on, you have a conversation about it. I had a bad employee. I had to get with the CTO. There's issues, nice story around it. This is what we did. Got a new guy in, actually is better, all that kind of stuff, right? So there's always a nice story. Well, there should be a nice story. And so do get a story right before you get going. And then on the seller side, how can we raise valuations on the seller side, Tricia?
Right. So, I mean, we talked a little bit about more buyers, right? More buyers creates a competitive process. And so looking through, again, to echo back that long tail of who else might be interested, in the company. And sometimes, I mean, it's as easy as, a number of companies put, customers on their website and customer testimonials. And if you share a customer, that is a phenomenal entry and to having that conversation. The next piece about this is finding out really who's the champion, within the buyer internally. Who's the person that's going to go to bat for you, and how do you arm them with enough material to do that in a cohesive way? So, are you giving them information about the competitive environment out there and how your product won over these 3 competitors? Are you telling them about how in combination you can go out to more customers that look like X, their favorite customer? I will tell you that finding and keeping that champion, engaged throughout the process and becoming their priority is really, really one of the keys to striking a higher value in negotiations and making them feel like this is something I've got to have. And I'm staking my reputation internally on that. Also, acquisition streaks, it happens. So, one buyer will do a deal. The next 3 buyers that are their competitors feel like they need to do a deal in the space too. And so it's, to Mark's point, it's easier to sell a second. 3rd and 4th is okay. You'll get a relatively same valuation. You may not get the top premium. But being 10th is very difficult. And so, being aware of who is selling in your space is very important in terms of kind of keeping those acquisition streaks, because you might need to wait, somewhere between, 6 and 18 months for another streak to develop. And so having just that general awareness of maybe I should perk my ears up if, I see 2 of my competitors sell, right? And then, valuation is also impacted on, do you get cash in the deal? Do you get stock in the deal? And are you, selling stock in the deal, right? Versus assets. All of those things can have sort of material impact on what you get at the end of the day. And so it's really important to have, conversations with your accountant. It's important to have conversations with your attorney, a banker, if you choose to use one. But all of those things are important as parts of the process because, it will matter on terms of what you get to keep. And we'll talk a little bit more about that later.
Yeah. So let's get to, so we've got an offer and now we're negotiating. So what's the key things to look for in a negotiation, Tricia?
Sure. So, I talked about what counts as what you get to keep, right? And so, one of the questions we had was about earnouts, upfront versus earnouts. So generally, as a rule of thumb, I think of, upfront is the cake, earnouts are the icing. So would you really be happy with what you've gotten upfront? And if you, achieve the metrics that are being measured as part of an earnout, where does that put you? And so the trouble with earnouts, honestly, is that they're often difficult to define. They have to be memorialized in the purchase agreement in a way that makes them easy to measure. Oftentimes, maybe there'll be a measurement around, revenue achieved going forward, or maybe there'll be a measurement around a milestone or some type of, forward action, which you won't have as much control over going forward as you might have now. And so, there are all sorts of ways for buyers to sort of starve you out of earnouts on a go forward basis, it's not in their best interest. And so it's not necessarily their goal, but you need to be thoughtful about how easy is it to hit these numbers. Did I show them incredibly wild growth numbers to begin with? And now am I going to be measured against those, 2 months later when we're getting to, the negotiation on an earnout? So, be thoughtful on the types of things that you present up front as part of this process. The other things that impact that, though, and what you get to keep are things like representations and warranties. Those have to do with, how do I present the business? Did I say that I had no legal issues, but I had an employee issue? Was there something that was untrue or I forgot about as part of this process? And you'll be on the hook for those things post-transaction. And sometimes those can carve back dollars that you thought you would otherwise get. Was there a big tax issue that you left unresolved? That all falls under the area of indemnification. So essentially saying, I made these statements about my company, and if they're true, then I get to keep the money that they've given me. If they're not true, for whatever reason, and it may not be through any necessarily fault of your own, then I may have to either give back some dollars, which we want to avoid at all costs, or have some dollars deducted from an escrow. And there's usually an escrow, put into these transactions. Those escrows, can range from 5 to 15% sometimes. If there is a particular issue that a buyer might be worried about, maybe they'll escrow a slightly larger, amount. So those escrows are really designed to give the buyer a bucket of dollars. So, hey, you're worth this entire bucket if all these things are true. But if one of those things were not true, then I might take back some of that money out of a defined pool that we've already set aside. So there's really a set aside, if you will. And then there are some tax matters. So, this is something to talk to your accountants about. At its basis level, ordinary income, those are things that are associated with employment. Capital gains, those are things that are associated with your stock and your sale of stock. And so ordinary income, high tax rate, capital gains, lower tax rate. So anything that you can have associated with your stock is really important. If there's something around, I have to be here for 2 years before I get an earnout dollar, you have to be really careful that that's really associated with, your stock and not with something that seems like they're employing you for 2 years, in which case you'll get taxed at a higher rate. So again, talk to your accountants about that. And then employee concerns. So, it's important that you understand, at least, is everyone, available to come to the party? Are they looking at, we've had transactions where, a certain very large buyer that has a very, very large market cap said, all the engineers have to relocate. We want them all with us. And that was a deal breaker. And we really, need to know those sorts of things up front. What types of synergies, and synergies is a banker word maybe for, either cost savings that, come from putting two companies together, and you don't maybe need two accounting systems, and you don't maybe need, two legal departments. To also include things like, hey, we're selling together. And because we're selling together, to Mark's earlier point, 2 + 2 is 6, right? That's also a synergy, a revenue synergy. And so you want to look at those things as well. And then to our second sort of major point, what if you already gave away the farm? So one of these things that you need to think about well in advance of transactions is, did I agree to things like exclusivity? Whether that was a distribution exclusivity or there was a first right of refusal that was attached to an investment from a strategic. All of those things can be impediments to getting a deal done quickly. They're not completely showstoppers sometimes, but not often showstoppers. But it is one of those things that you need to sort of have a bigger view on in terms of if, in order for me to get this $2 million investment from a strategic, I said that I would go to them first if I ever got approached. And that's fine. You just need to make sure that you have the right pacing of a transaction so that you can go to them first, notify them that you've gotten maybe an offer, and then use that, if you can, to negotiate more aggressively with your other suitor. And then just lastly, assignment clauses. If you've got key contracts, there's usually some assignment language in there, and just understanding, kind of across the board, which of those contracts will allow you to do a transaction, and which of those contracts either have some notice right, where maybe a big customer wants you to tell them before you go and sell. Maybe there's a termination right. Again, a large customer may say, well, if you go and sell your company, I have the right to terminate this contract. Those sorts of things can be very meaningful in the negotiations. And again, flagging them up front, again, to Mark's earlier point, will save a lot of heartache down the line.
Yeah, we touched on quite a lot of this already, but let's talk a little bit about what an advisor does. And we've got a list here, Tricia, of things we touched on already. Maybe we can go through this real quick because we're short on time, I think, now.
Sure. So the quickest thing here is, do you need an advisor? Again, This is, people will come inbound. The first offer, you want to make sure it's a competitive thing. It's a complex process. There are a lot of, even after almost 100 deals, I'm still surprised sometimes by how things turn out. And so, getting someone who's got some practice is very helpful. And it can be, significant time drain as a process to go through. Your job as an entrepreneur is to make sure your business is rolling through all of this uninterrupted. So, how quickly, you don't want to take your eyes off the ball. Honestly, you want to make sure that you're hitting the revenue marks that you said you were going to hit, that the customer counts, that, customers aren't churning during this process. And so oftentimes, the M&A process in general can really take a huge amount of time away from what should be your primary focus. And so, let someone else do that heavy lifting, and let someone manage the lead gen, the top of the funnel. Because ultimately, as we mentioned, this is an enterprise sales job, but it's with your company. So, let someone do all of that top of the funnel work so that really you're dealing with the most qualified, interested sales targets that you have available to you.
All right. So, well, who do you hire then, Trish? Do you think we should hire these guys? I don't
Please
think
don't hire those guys.
Probably not the best thing. Well, they're highly motivated at least. Now let's look at what makes a good advisor. Well, just want to go quickly through this. They're going to be representing you, right? So an advisor is representing your company, representing you as a CEO, perhaps. And so a good advisor will have a wide appreciation of your sector, and you can test this. This is something you should ask. So when you interview an advisor, get them to talk about your sector, how your product, how your company fits into the sector. What are the main drivers there? What's happening? Is it consolidating, expanding? Who are the competitors? And get them to basically just interviewing them to say, will you be able to represent my company in this sector? And that's important because they're going to again represent you to the buyer. So and we talked about this before. So the buyer wants to know, how does it fit into the same sector? So. And of course, transactions, very good to have transactions in the same sector. You made some sales already, you've sold some companies. The third point, and it's deliberately third out of 6, because you're going to be working with these guys, depending on what you do, but between 6 and 9 months. So just like any other, and it's a team game, like Tricia said earlier on. It's, selling a company is a team sport. So you do need to interview them in the same way you would do interviewing any other team member. They're going to be part of your virtual team. You need to get on with them and make sure that the folks that you see are the ones you get on the team. Don't have a bait and switch situation. Would be ideal if you could have an advisor that provides people that have had experience of being a CEO and have also had experience of being on the buyer side, because then you get the whole spectrum of advice. You're getting the advice of, here's what I do as a CEO, here's what I did in the past as a CEO. You get the banking advice, of course, you get advisor advice. And then on the other side, you're getting, well, as a buyer, this is what I wanted to hear. This is what you should be telling me. And so you get the whole spectrum. That's a much better comment. And of course, even better is if you get an advisor that has an existing relationship with a buyer. And part of that comes from the transactions before, but it could also be, that they're out and about in the community, they've been to conferences, they met people, and they can name people. You can test this, that you can ask them to name the buyer. And so do that. We talked about this a little bit, so I won't go into dwell on this too much, but very important that you have someone that can explain the fit, right, for the buyer. So test them on that. What is the fit with this buyer? So that's a good thing to do. The selling process, Trish, tell us a little bit about
Sure.
that. Quick.
I'll go through this quickly because I know we're running out of time. The selling process typically falls into, a couple of different phases. And, there are, 5 here. I'm going to talk about 3. The first really is that, data gathering, collateral presentation, around who am I and who am I selling to, right? So, looking at those buyers. Then there is a marketing phase, going out and, doing the pre-qualification, understanding, that back and forth on buyer conversations, and really getting essentially then to, negotiations, a letter of intent, a term sheet. And then the third phase is this deal documentation. So the first phase is controllable because you can, how long does it take you to put together collateral? The second stage, incredibly variable. So depending on how many deals have been done in your space, how evolved is the conversation that you've had with buyers to date? Do they know you? And then that last stage, the deal documentation stage, is very, regimented. It's typically 30 to 60 days of due diligence, and the final deal documentation will be done at the same time in parallel.
I'm gonna skip one slide here. Trish, we had a slide about whether you're in trouble, but let's jump to this is a summary slide. It gives the 7 considerations you should look at when selling your company. I'll leave you to read that, and maybe we can have a look at some questions in the last 2 minutes. My clock says.
Yeah.
Are there any questions that jump out there?
Yeah, I mean, I think this is, we've tried to sort of summarize, here are the things. It's not easy. People are going to, bang on your door at all hours of the night and day, asking you whether or not you want to sell, and you have a company to run. So that's, one of those things that as you go through this process, you need to be thoughtful about, the types of interactions that you engage in, and, how do you get the right set of buyers together to have those conversations.
Yeah. And on the buyer side, just quickly for 15, 20 seconds, we touched upon this a lot. It's when I was a corporate buyer, if it came with an advisor, I was thinking, oh dear, on the one hand, oh dear, this is a serious situation, and we have to be diligent in what we do. It was just more rigorous, but they also was calmed by the fact there was a bank involved, because I knew exactly what the process was going to be. It's a routine that the advisor has been through before, but you have to be careful not to get steamrolled, I guess, by a large buyer. They can come in and say, you should definitely go with us and all that kind of stuff. So do get someone in that can advise you on that. And it also helps. We talked about this with the fear of missing out then on the negotiation side, and having a bank there to do the first round of negotiations does leave you with you're going to work for these guys afterwards. So you don't want to be getting into a competitive and nasty situation on negotiating. You want someone else to do that, and then come in at the end and be the nice guy and you still got the chance to do the negotiation, so you've got like a second chance at negotiation as well. So, did there
And
anything?
I'll answer a question that Alan
Yeah.
asked about the typical, sort of cash to earn out ratios. Unfortunately, it can depend. The one issue on the financial buyers, so private equity buyers will often say, I'm looking for a majority buyout. I want to own more than 50% of the company. And you can roll your portion, your remaining portion. If I buy 60%, you can roll 40% on a forward basis. And that'll essentially act as your earnout, if you will. And so bankers will call that taking 2 bites out of the apple. So you take the first bite when you sold the first time for your 60, 70, 80% of the company, and you'll take that second bite when there's a later transaction, likely in kind of the 3 to 5 year time frame. In a transaction with a strategic, sometimes it's really, earnouts are really just designed to bridge valuation expectations. So if you think you're worth 7 times revenue and they think you're worth 5 times revenue, you might use an earnout. If you think you're going to grow 200% year over year, they think you're going to grow 50% year over year. Again, you might use an earnout. Generally, the bulk of the dollars will be in that upfront amount. And the earnout dollars will be, somewhere between 20 to additional 50% in value. But there are exceptions, and I've seen earnout dollars that were 2x, 3 times what the upfront amount was. What about you, Mark?
Yeah, along the same lines, I think really not much more to add on that one.
Any other questions from the group that we didn't answer? As we
I
were
was
going
looking
through all
and
the secrets.
I think we're okay.
And we're actually just over time. So if we didn't get to your question, apologies, but there was so much content in that presentation that was amazing. So thanks for sharing your secrets with us. And thank you so much for joining us. Hope to see you guys soon.
Thanks, everyone.